We are right in the thick of bank earnings, and the theme which is emerging from them is credit losses. Provisions and charge-offs have soared this year, especially where it comes to consumer loans like credit cards. It's more powerful and consistent evidence that the economy has indeed turned and the labor market is stumbling pretty badly. For banks themselves, they're already dealing with a swirl of questions surrounding their net interest incomes. The firms have to be feeling the pressures, especially when credit losses are rising, taking a growing bite out of their earnings. JP CEO Jamie Dimon, he even snapped at analysts on his conference call. What he said was highly revealing. More fundamental analysis from Dimon in a short fit of anger than has come out of the Fed or JP Morgan, for that matter, in years. At the same time, legendary stock investor Warren Buffett has kept on selling huge chunks of Bank of America, and everybody wants to know why. The answer appears to be, at least to me, the same as what has upset Jamie Dimon. The economy is getting more sour, not soft as in landing. Not only do we see it in these quarterly bank reports, consumers themselves continue to report the same thing. New data from the New York Fed, unfortunately, it fits exactly with what we're seeing here in these loan charge-offs. More Americans told FRBNY they fear they'll miss a debt payment and end up on JP Morgan's crap list. So higher loan losses are an issue for the banks and their earnings potential, as is net interest income, which is tied to the same fundamental properties. And both are trending in the wrong direction and going way too fast in it. So despite the Fed's rate cuts and China's massive stimulus, why else is oil down 5% today? As the crazy man once said, it's the economy, stupid. And all the evidence continues to pile up, showing that, first of all, consumers are indeed really struggling. And it's not about past purchasing power that they've lost. It's that plus what they see in the labor market. And the labor market tells them not only do they have trouble ahead, they're not going to make up for the past. So oil prices are down 5% today, as it looks like maybe the Middle East will calm down for the next little while, next couple of weeks anyway. And that means the market can focus on demand more specifically. And whenever the market focuses on demand, whether it be China, the US, or everywhere in between, it sells off dramatically. And again, despite the fact that the Chinese and oil markets have a massive China demand problem, despite the fact the Chinese government announced massive stimulus, it is not impacting oil, at least not in the way that Beijing would like, or anyone else for that matter. As parts today, oil was under, in the US, WTI was under $70 per barrel. Gasoline, wholesale gasoline prices in the US right back to $2 per gallon, which is another key indication of stress and strain, lack of demand in the US. Even treasuries that have been selling off predictably, as I noted in a recent video, even as they have sold off after the payroll report from a little over a week ago, they appear to be leveling off too, not convinced that the Fed's rate cuts are going to help, nor are they pricing a resurgent global economy from the Chinese and all of that they're doing. But where it comes to the banking system specifically, it started before this month. In fact, you go back last month to the Barclays conference I talked about in September. Ally Financial's chief financial officer, Russ Hutchinson, he attended the Barclays conference and he said, well, here's what he said. Over the course of the quarter, our credit challenges have intensified. Our borrower is struggling with high inflation and cost of living, and now, more recently, a weakening employment picture. As that pool of struggling borrowers in those later stage delinquency buckets has grown, it gives us pause. And it gave stock investors in the company pause as they sold down the shares, and Ally Financial was down big that day. And it hasn't really done too well since then. And we're seeing that more and more come up across a whole variety, a whole wide range of data, including the bank reports we'll go over here in a second. But consumers themselves are telling them they're strained. They are strained not just because of lost purchasing power, as I said, but as Ally Financial's Hutchinson also admitted, the lost purchasing power plus weakening in the labor market more recently. Tie those two things together. Charge-offs, delinquencies, problems in loans, consumers, incomes, labor, jobs. And now it's not just Ally Financial, it is becoming widespread. And the numbers, the loan loss provision numbers, are getting huge. Now, we're not talking about a banking crisis. We're not saying banks are going to fail. Our interest here is more data, more indirect data that tells us the labor market has indeed cracked. And as the labor market cracks, that means there are going to be more cracks across the entire economy as we continue to move forward. It is that cracking that appears to have gotten Warren Buffett's attention. He has been selling Bank of America stock, and he's a huge shareholder in Bank of America. And everybody's been wanting to know ever since it started a couple months ago, why is he selling consistently when he says Bank of America is a good company? And it doesn't seem to be consistent with the idea overall that everything is just fine. Just last week, it was reported that Warren Buffett sold even more, another 9.5 million shares, which brought his stake below the 10% reporting threshold. Now, it may be that he just wants to not have to disclose everything he does with Bank of America, but that doesn't seem very Warren Buffett-ish, does it? And as far as Bank of America goes, what they just reported in their earnings, it very much goes along with why people would be cautious about the bank. It's about net interest income, and when it comes to net income, the potential for rising loan losses. Now, Bank of America reported revenues that rose 1% to $25.5 billion, but net income dropped 12% year over year, and they cited rising expenses, as they all do, but also it was impacted by higher loan losses and loan loss provisions. Furthermore, net interest income declined 2.9% year over year to just $14.1 billion. So they got pressure on that interest income as interest rates go down because of fundamental reasons, as Jamie Dimon will talk about, and we'll talk about what Dimon said in just a second here. But as net interest incomes go down because of fundamental reasons, now we've got rising loan losses for the same fundamental reasons. Rates go down, lower growth and inflation expectations, pressures in the economy. Pressures in the economy lead to consumers and businesses too, as we'll see in some of these banks, having problems paying back their loans. So delinquencies in loans and provisions rise for the same reasons that net interest income gets pressured. As far as Bank of America is concerned, their loan loss provision was $1.53 billion in the third quarter, which is the same as the second quarter, but that was up from $1.498 billion in the first quarter and $931 million back in the third quarter of last year. More cyclical signals because this is still a cycle. And all of these bank results are in many ways, as I said, really proxies for the labor market. And that's something I wrote about at our deep dive analysis just yesterday. Whether employers are using another tactic to circumvent laying off workers. And that's what Eurodollar University is here for, to expose what economics won't. And right now we've got our fall sale, which is winding down to its last days, and where we're offering incredible discounts on everything. There's also my daily briefing that keeps you up to date on all the latest data, and more importantly, what it means, plus Eurodollar University memberships that have a ton of content going over the basics, the history, the mechanics of everything in the globally synchronized Eurodollar world. If you want to know how the monetary system works, how it affects the economy and our markets, our subscriptions got you covered, and there's details about them, as well as the huge savings that we're offering in our fall sale that can all be found at our website, eurodollar.university. Following up Bank of America, JP Morgan. And Jamie Dimon was not happy with all of the talk about forecasting net interest incomes. Again, fundamental values behind it. Revenues for JP Morgan during the quarter were about $42.65 billion, but net interest income at $23.5 billion, that was only up 3%. And when you excluded the market segment, it was only up 1% year over year. And there was forecasts from the company that said they expect the net interest income to decline slightly to $22.9 billion in the coming quarter. And as Dimon was peppered with questions about forecasting net interest income, he appeared to completely snap. At least that's what came through from the transcript. Can I just say something? First of all, next time they should give them the damn number. I don't want to spend all the time on these calls like going through what they're guessing what NII or net interest income is going to be next year. And can I just point out that the NII, all things being equal, is a number, but all things are never equal. And the yield curve, if we have a recession, the effect of the yield curve will be very different than if you have continued growth. So for once, he's saying yield curve fundamental values, not the stuff that he always talks about, how treasuries are going to be a disaster. If the yield curve continues to go in the direction it has, that will be bad news for pretty much everyone, including Jamie Dimon and his net interest income. And it'll be bad news because lower net interest income, but also rising charge-offs. Fundamentally, Dimon was saying here, net interest income is tied to the yield curve, which is, if there's a recession, bad news because lower growth and inflation expectations. It's all fundamental and it's all the same thing. So net charge-offs, according to JP Morgan's reports for the third quarter, they were $2.1 billion, plus they added another further billion for their net loss reserves, for a total of $3.1 billion charged off against earnings. That compares to $3.05 billion in the second quarter, so second straight quarter of a pretty substantial total. And it would only been $1.38 billion in the third quarter of last year, so substantial increase in charge-offs and reserves. And they said they were predominantly driven by card services. That included $882 million from consumers, primarily cards, as well as $144 million in wholesale. And we look at just consumer and community banking alone. That's where $2.795 billion in provisions for credit losses were, which was almost double what it had been in the third quarter of last year, which is a lot for the revenue in the segment, which was just $17.79 billion. So you're charging off $2.795 billion off of $17.79 billion in revenue. That's why income fell from $5.895 billion in the third quarter of last year to just $4.046 billion in the third quarter of this year. So falling net interest income, potentially falling a lot more, angering Jamie Dimon, higher loan loss provisions, especially for consumers. What are we saying here? We're saying the economy is in trouble and it's angering the bankers because they can see it happening right in front of them. But of course, one final note, JP Morgan's chief financial officer on the call, he said, well, you know, consumers, they are, quote, on solid footing. And it sounded just like what Jay Powell said about the economy after the 50 basis point rate cut, where he said the economy is otherwise on solid footing. Maybe that's the talking point they've all distributed, which belies everything that we're getting from these reports and all the data, including what we'll get from the Federal Reserve, as I'll go over in just a second here. The third bank that we want to talk about is Citigroup, just rounding out the group here. Citigroup's revenue, $20.3 billion. Net interest income, $13.36 billion, which was below expectations and down 3% year over year. Again, loan losses, $2.7 billion in the third quarter of 2024, which is up sharply from $1.8 billion in the year ago period. And just like JP Morgan, largely driven by higher charge-offs and problems with credit cards, including higher allowances for credit losses, as well as actual charge-offs. And it was Citigroup's chief financial officer, Mark Mason, who back on September 9th at that same Barclays conference that Ally Financial's CFO was at, he mentioned the same thing. He said, according to Bloomberg, credit losses are rising as U.S. consumers shift spending to basic needs and away from purchases that aren't vital. The nature of spend is evolving. That's what Mason said at the conference. It's going from discretionary to a more staple type spend. And it's leading to problems, and it's caused by the stumble in the economy, the labor market. It is not what the payroll report said for September anyway. It's what the payroll report said in terms of hours. It's what the unemployment rate has been saying as it's been rising. It's what the lack of hiring that we see from any number of data points, including the household survey as well as JOLTS. And on top of everything, from these bank reports, as well as what consumers continue to tell us about what they perceive as their own situation, as well as the overall economic situation. They continue to report increasing pessimism about incomes, about jobs, and about their ability to pay back on loans, credit cards. The latest result from today from the Federal Reserve Bank of New York surveys of consumers showed a whole bunch of things, but primary among them, especially given the topic that we're going over here with loan charge-offs and credit cards and everything else, the mean probability calculated by the Federal Reserve Bank of New York for missing a debt payment rose to 14.22% in September. That's the highest outside of March and April 2020 since 2017. In 2017, you may not remember, that was the last time the economy went through a hiring freeze that was nowhere near as bad as the one that we're going through now. So even consumers are starting to report they're concerned about missing a credit card payment or another debt payment because we're already seeing a lot of consumers do so. And what the data tells us is that those who are already missing payments, there's more behind them that fear they're going to follow along in the same way. And the reason they're all doing this is because of the labor market. The probability, again, the same consumer report from Federal Reserve Bank of New York, the probability of finding another job if you lose one this year, this is what they asked consumers, is right around 52.73%, which is a low number. In fact, it's hovering around a low. I talked about this in a video last month. So not a lot of people believe that if they lose their job, they're going to be able to find another one. In fact, at the margins, more people believe they won't be able to than we've seen in quite some time. You also see the pessimism to an extent in consumers' perceptions of price changes. Now, the one-year price change, according to FRBNY, the median was right at 3%, where it's been for the last 4 months in a row, plus or minus a few basis points. But the median for the 3-year outlook was just 2.66%. Now, it's up over the last couple of months, but in July, it had dropped to 2.33%, which was a record low. So consumers are looking ahead and thinking, well, consumer prices right now appear to be stable. There's a growing chance of something bad happening in the economy that leads to lower prices over the intermediate term, which goes along with what they're saying about the labor market not being able to find another job if they get laid off, as well as their growing fears that they'll miss a debt payment if something bad happens to them, because there's a lot bad happening already. Not only do they see it, they hear about it. It's information coming up from consumers themselves about the labor market. Again, this is something we've seen in terms of consumer confidence. Consumer confidence isn't really about consumer spending. It's the same things that we're talking about here. Consumer confidence is a reflection of employment and job opportunities. So Allies said it last month. Hey, we don't like what's going on in terms of especially consumer loans. Our consumers are the ones that have loans with us. They're really struggling here. And now it's showing up in the actual earnings reports of the largest banks in the U.S., some of the largest banks in the world. And they're all showing the same thing. Rising loan losses and provisions based on primarily consumer loans. Also business loans, those are ticking up too, delinquencies there. But it's about consumer loans because the labor market is where the entire problem really lies. Regardless of what the payroll report for September said, everything that we continue to see outside of that, including the establishment survey and hours and everything else, the rest of the establishment survey, everything outside the payroll report tells us the labor market is not fine. Even if it's not experiencing massive layoffs, it is experiencing all of the other things that go into a recession. As I keep pointing out, recessions are not about firing. They're about lack of hiring. And that lack of hiring leads to everything, all the symptoms that we're seeing here, from bank charge-offs to consumer pessimism to lower growth and inflation expectations in market interest rates. And on top of everything else, crashing oil and energy prices that are about demand as well. There's a reason why central banks all over the world, from the US and its rate cuts to Canada to Europe and of course China, are appealing to more and more what they call stimulus, because they are responding to the same fundamentals that we see pricing in markets as well as in these bank reports with soaring credit losses and provisions. I had briefly mentioned that interest rates normally rise after the Fed starts cutting rates. And while that seems counterintuitive, that's what happens every time. And I went over that in the video linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. If you want to become one, now's the time to do it. The fall sale is winding down. And until next time, take care.